Options trading can seem daunting, but it can also be a powerful way to grow your investments. Imagine having the flexibility to buy or sell assets at predetermined prices. This can offer both opportunities and risks. In India, options trading is gaining popularity. This is due to its potential for high returns and strategic advantages. This guide aims to give you a solid understanding of options trading. We will break down complex terms into simple concepts. By the end, you will feel more confident about starting your journey. Whether you're new to trading or looking to diversify your portfolio, this guide is for you. Options trading has its roots in ancient Greece. It has evolved significantly since then. Today, it is a vital part of the financial markets worldwide. India is no exception. The country's dynamic stock market offers numerous opportunities for traders. Let's dive in and explore the fascinating world of options trading in India. We'll start with the basics and gradually move to more advanced topics. Are you ready to learn? Let's get started. Options are financial instruments. They derive their value from an underlying asset. This asset could be stocks, indices, or commodities. Unlike buying stocks outright, options give you the right, but not the obligation, to buy or sell the asset at a predetermined price. There are two main types of options: call options and put options. A call option allows you to buy the asset. A put option allows you to sell the asset. This right to buy or sell comes with an expiration date. Understanding this is crucial to mastering options trading. Options trading involves terms like strike price and premium. The strike price is the price at which you can buy or sell the underlying asset. The premium is the cost of the option itself. It is what you pay to gain the right to execute the option. Options can be used for hedging or speculation. Hedging protects your investments from adverse price movements. Speculation, on the other hand, aims to profit from price changes. Both strategies require a good understanding of market dynamics. Call and put options are the building blocks of options trading. A call option gives the buyer the right to buy an asset at a specific price. If the market price exceeds the strike price, the buyer can purchase the asset at the lower strike price, making a profit. For example, imagine you buy a call option for company X at a strike price of 500 rupees. If the market price rises to 550 rupees, you can still buy the shares at 500 rupees. Your profit would be the difference minus the premium paid for the option. A put option, on the other hand, gives the buyer the right to sell an asset at a specific price. If the market price falls below the strike price, the buyer can sell the asset at the higher strike price, thus limiting losses. Consider buying a put option for company Y at a strike price of 300 rupees. If the market price drops to 250 rupees, you can still sell the shares at 300 rupees. Your profit would be the difference minus the premium paid for the option. These options provide flexibility in trading. They allow you to capitalize on market movements without owning the underlying asset. This can be a powerful tool in your trading arsenal. Options trading offers several benefits. One of the main advantages is leverage. With options, you can control a large number of shares with a relatively small investment. This can amplify your returns if the market moves in your favor. Flexibility is another key benefit. Options can be used in various strategies to suit different market conditions. Whether the market is bullish, bearish, or sideways, you can find an options strategy that works for you. Risk management is also a significant advantage. Options can be used to hedge your portfolio against adverse price movements. By doing so, you can protect your investments and limit potential losses. Income generation is another benefit of options trading. Writing options or selling options you own can provide a steady income stream. This is especially useful in a volatile market where predicting price movements can be challenging. Section 5. Step-by-step guide to start options. Trading in India. Starting options trading in India involves several steps. First, you need to open a trading account with a broker that offers options trading. Ensure the broker is registered with the Securities and Exchange Board of India, or SEBI. Next, you need to understand the basics of options. This includes learning about call and put options, strike prices, and premiums. Many brokers offer educational resources to help you get started. Once you're familiar with the basics, it's time to develop a trading strategy. This involves analyzing market trends and identifying potential opportunities. It's essential to have a clear plan and stick to it. Finally, start trading with a small amount of capital. This allows you to gain experience without risking too much. As you become more confident, you can gradually increase your investment. Section 6. Choosing a broker. Choosing the right broker is crucial for options trading. Look for a broker with a solid reputation and good customer service. The broker should offer a user-friendly trading platform with advanced features. Consider the fees and commissions charged by the broker. These can vary significantly between brokers. Ensure you understand all the costs involved before opening an account. It's also important to check the broker's educational resources. A good broker will provide tutorials, webinars, and other materials to help you learn about options trading. Finally, consider the broker's trading tools and research capabilities. These can help you make informed decisions and develop effective trading strategies. Section 7. Developing a strategy. Developing a strategy is critical for successful options trading. Start by identifying your financial goals. Are you looking to generate income, hedge your portfolio, or speculate on price movements? Next, analyze the market. Look at historical price data, news events, and other factors that could influence the market. Use technical and fundamental analysis to identify potential trading opportunities. Once you've identified a potential trade, decide on the best option strategy. This could be buying call or put options, writing options, or using more complex strategies like spreads and straddles. Finally, manage your risk. Set stop-loss orders to limit potential losses. Regularly review your trades and adjust your strategy as needed. Section 8. Practical example. Let's consider a practical example. Suppose you believe that the stock price of company Z will rise in the next month. You decide to buy a call option with a strike price of 600 rupees, expiring in 1 month. The premium for this option is 20 rupees per share. If the stock price rises to 650 rupees, you can exercise your option and buy the shares at 600 rupees. Your profit would be the difference between the market price and the strike price, minus the premium paid. In this case, your profit would be 30 rupees per share. 650 minus 600 minus 20. If the stock price does not rise above 600 rupees, you can let the option expire. Your loss would be limited to the premium paid, which is 20 rupees per share. This example illustrates the potential for profit and the limited risk of loss in options trading. Section 9. Risks of options trading. Options trading is not without risks. One of the main risks is the potential for loss. While buying options limits your loss to the premium paid, writing options can result in significant losses if the market moves against you. Another risk is the complexity of options trading. Understanding the various strategies and their potential outcomes requires a steep learning curve. Mistakes can be costly, especially for beginners. Market volatility is also a risk. Sudden price movements can result in unexpected losses. It's essential to stay informed about market conditions and be prepared for potential price swings. Finally, there's the risk of emotional trading. Fear and greed can lead to poor decisions. It's important to stay disciplined and stick to your trading plan. Section 10. Encouraging responsible trading. Options trading can be a rewarding endeavor if approached responsibly. Start by educating yourself about the basics and gradually move to more advanced concepts. Take advantage of the educational resources offered by your broker. Always trade with a clear plan. Set realistic goals and stick to your strategy. Avoid making impulsive decisions based on emotions. Regularly review your trades and learn from your mistakes. Most importantly, never risk more than you can afford to lose. Start with a small amount of capital and gradually increase your investment as you gain experience. Remember, options trading is a journey. It requires time, patience, and continuous learning. Stay informed, stay disciplined, and trade responsibly. Good luck on your trading journey.